Welcome back. Well, today we're going to take a little bit of a different direction. We're going to take a deep dive into some of these economic numbers. So hopefully we can get a better understanding of how these numbers go into influence the Federal Reserve's decision to raise or lower interest rates and implement their tools of monetary policy. So we see these numbers are released throughout the week, and hopefully this will shed some light into what these numbers really mean. So today we're going to talk about inflation, all kinds of inflationary numbers. Well, the CPI, the Consumer Price Index, is the most commonly watched gauge of inflation. It measures the changes in the prices paid by consumers for a basket of goods and services, which represents the U.S. economy. We talk about the core CPI, which is the CPI that excludes food and energy. Food and energy tend to be more volatile components of the market. So when we take food and energy out of the CPI, we have core CPI. Now, again, within the core CPI, which excludes food and energy, we can measure those volatile components separately. We take a look at CPI energy, which is a sub-index that tracks energy prices. We have CPI food that tracks the change in food and beverage prices. Then we also consider the PPI, the Producer Price Index, which very simply measures the change in the prices received by domestic producers. Basically, it's the cost of doing business. This is the change in prices that the producers, the manufacturers, must bear. We also talk about the PCE, the Personal Consumption Expenditure. And what that is the price of goods and services purchased by households and the government on behalf of households. Now, the PCE is similar to the CPI, but there are differences that we're going to take a look at. And then, of course, with the PCE, we also have the core PCE, which again excludes food and energy prices. Now, first taking a look at the inflationary numbers, this is going back to 2014. It's a monthly index. The jagged blue line over here is the standard CPI. The orange line is a core CPI. You'll notice a core CPI, which is again the CPI, the Consumer Price Index, except not including food and energy. That's usually right above the blue one. They track very closely together. We have the green line, which is the CPI Food Index. We have the red line, which is a very jagged line. That's our energy index within the CPI. Notice it hit a very big low back in April of 2020 and then skyrocketed to the upside. We have the blue line below this, which is the PPI, the Producer Price Index. Notice the PPI tracks in a parallel fashion to the CPI, but lower down. And then much lower we have are the PCE and core PCE, and these are measured on a different scale, and that's why they're lower down. But they all tend to travel in the same direction. Of course, there are divergences that we're going to take a look at. Now, let's first take a look at CPI, Consumer Price Index. The standard CPI is what we see with the white area chart here. Starting in 2014, we began to trend higher. We had a little bit of a blip to the downside in early 2020, but then continued to skyrocket higher. Now, the core CPI, which is the green jagged line, notice travels above the white area chart. But there are times that there's more space in between the green line and the white area chart, and there's times when these two lines actually diverge together. Now, the black line represents the CPI Food Index, and again, sometimes when the food index travels lower, it almost touches the white area, which is the CPI, and that shows us that the price of food is dropping in relation to the overall CPI. And then, of course, you have that red line, which is the energy index within the CPI, which took a huge hit to the downside in early 2020 and then skyrocketed higher. Now, notice when the black line and the red line, when the CPI food index and when the CPI energy index really went up, that affected the white area chart. Remember, the white area chart is CPI, which includes food and energy, which includes the black line and the red line. So when the black line and the red line go up, when food and energy goes up, that pushes this white area chart up. And that pushes us even a little bit above the core CPI, which is not affected by food and energy. Food and energy affects this white area chart, but not the green line. Take a look at CPI versus core CPI. Now, core CPI is a blue area chart. The red line is CPI. And again, the blue area chart does not include food and energy. Notice we hit a really significant point around June of 2022. That is when the CPI, which again includes food and energy, traveled actually a little bit above the core CPI, which does not include food and energy. And notice the volatility. Really, it's a very subtle chart here, but the numbers are actually quite dramatic in the sense that food and energy, especially energy, caused the core CPI to fall a little bit below, or the CPI, which includes food and energy, to cross a little bit above that core level. Now, let's consider CPI, the Consumer Price Index, versus the PCE, the Personal Consumption Expenditure. First, CPI. It's more volatile because it includes consumer goods and food and fuel. It uses data from household surveys and measures the change of price in goods and services that are purchased by only households. It covers out-of-pocket expenditures on goods and services purchased. It excludes costs that are not directly held by the consumer, meaning that prices for the cost for Medicare, Medicaid, medical insurance, which is paid for by the employer, that is not included in the CPI, and it's an important aspect to keep taken into consideration. The CPI does not include medical insurance and those other, benefits that are paid. It also covers a broad range of goods and services, including food, housing, transportation, healthcare, etc. But again, not the insurances. Now, the PCE, which is also an inflation index, it's less volatile than CPI. It's more stable. It uses data from the GDP report, the gross domestic product. Again, the CPI comes from the household surveys. The PCE comes from the GDP reports. Now, the CPI, we said it covers the cost for goods and services purchased by households only. The PCE covers the cost of goods and services by households and nonprofit organizations. It's actually, the PCE is a more comprehensive measure than the CPI. Now, costs like Medicare, Medicaid, employer-based insurance policies, that is included in the PCE, not in the CPI. And the changes for goods and services purchased by households, and also the costs brunted by governments when they purchase goods and services on behalf of households. So any kind of benefits packages, anything like that, that is included in PCE. The CPI, think about it, it's just more the standard consumer behavior. Not medical insurance, not Medicare or Medicaid, not government programs. The PCE does include government programs. Now just keep in mind, by the way, the PPI, which we'll talk about in a minute, that measures the change in the prices that are carried by the producers, meaning how much does it cost for a producer to buy these goods and services. Now, compare the PCE to the core PCE. It's the same chart as we saw before. Remember the CPI and the core CPI? The CPI, the red line, which traveled above the blue area chart when energy prices really went higher, it's the same type of thing that we see here. That the core PCE is the green area chart. The blue line is PCE. That does include, again, food and energy. So in June of this year, when food and energy, especially energy prices, really spiked higher, June of last year, I should say, 2022, that's when the PCE actually traveled a little bit above the core PCE. Now compare the CPI and the PCE. Now this is interesting. The blue line at the top, that's CPI, Consumer Price Index. The red line at the bottom is the PCE, the Personal Consumption Expenditure. Remember the differences, the CPI is just the average consumer, the PCE covers government programs and those type of costs. Well, the purple area chart measures the difference between the two. And notice, really starting around June of this year, of 2020, I should say, to present date, that has spiked higher. What does that mean? It means that CPI has risen a lot more than PCE has in the past couple years. Now again, remember the difference, the main difference, well there's a lot of differences, but one of the big differences between CPI and PCE is that CPI includes only regular households. The PCE also covers nonprofit organizations. The CPI does not include Medicare, Medicaid, employer-based insurances, the PCE does, and as well government programs. So what does this show us? That the real sharp rise in prices has affected more the average consumer, much more so than government programs have gone up or Medicare, Medicaid. Those are a little bit more constant. The real rise, and that's what we see by this purple area chart, which again reflects the difference between the two. The blue line really went up a lot more than the red line did in the past 2 or 3 years. And that shows an additional cost bared by the consumer, not so much those government programs. Compare now the CPI to the PPI, Consumer Price Index versus Producer Price Index. The blue line is CPI. That's how much the consumers pay. The PPI is the Producer Price Index. That's how much the producers pay for raw goods and services. Now, the white area chart shows the difference between the two. It spiked to a really big high in March, April of 2020. Then really started to go the downside. That shows us a contraction. It means that consumer prices went up, but producer prices really went up as well. That shows us actually that the producers bared a lot more of the cost over the past couple of years. Notice how much faster the red line has been traveling higher in the past couple of years than the blue line. That's reflected by this white area chart moving down in a very quick fashion. So we see the rise in prices now. That is actually a delayed effect from what the producers, the prices have gone up for the producers a lot faster than it did for the consumers. Eventually those higher prices did translate onto the consumers, but first they were bared by the producers. Now, very interesting. Compare the difference between the CPI versus PPI and the CPI versus PCE. Specifically, in the CPI versus PCE, Consumer Price Index versus Personal Consumption Expenditure, the purple area chart fired up higher. In the second chart here, the white area chart, which shows the difference between the Consumer Price Index, Producer Price Index, actually went down. It shows us that the prices for the consumer, excluding government programs, excluding Medicare, Medicaid, employer-based insurances, insurance costs, that has really gone up a lot. The consumers paid a lot more than the consumer, including government programs and things of that nature. But the consumer has also paid less than the producer. So if we had to rank all these, it's actually the producer that their prices have gone up the most, the fastest. That's followed by the regular consumer and then the PCE, which includes Medicare, Medicaid, and other programs. Now, moving forward, of course, we want to try to forecast. We're going to try to take an educated guess what we think market's going to do, and markets are very heavily influenced by the Federal Reserve decision to raise or lower interest rates and their effect on monetary policy. Well, inflation is a very, very big component. Now, the Federal Reserve will obviously be much more likely to raise interest rates if inflation's going up, but lately what has been the theme? Inflation's coming down, and therefore, if inflation's coming down, well, the Federal Reserve maybe is going to stop raising rates. Maybe they're even closer to cutting rates. Well, what can we take away from all this? Well, if history is any judge, we see that the Producer Price Index went up the fastest. That followed by the CPI, and then, of course, the PCE. So when we look forward to these reports, personally, I want to watch the PPI, the Producer Price Index. If this red line really starts to fire up higher and break estimates and exceed, our analyst's best guess, I would venture to say that maybe the CPI will follow. And if the CPI goes up, we want to see how much is going up more than the PCE. If they're all trending higher at the same rate, and this purple chart and this white area chart kind of stay flat, that's not such a big deal. But if we see that this white area chart continues to go lower, meaning the PPI is going up even faster than the CPI, well, that tells me that maybe the Federal Reserve is more likely to raise interest rates sooner or continue to raise interest rates more than we thought. Last but not least, when we talk about inflation, we always obviously talk about the 1970s and 1980s. I want to take a quick snapshot what that looked like. Now, the white area chart is the standard CPI, Consumer Price Index. This is going back to 1970 through 1989, 1990. Now, inflation skyrocketed during these 2 decades. During that period of time, the purple area chart, the purple line is a core CPI excluding food and energy, tracked very, very closely. In fact, we can see in the latter part of the 1980s, food and energy actually wavered because this purple line went up a little bit more than the white line. There's a little bit space. There's a little bit of space between the purple line and the white area chart. That shows us that food and energy, dissipated to some extent. Now, of course, we have the PPI, the Producer Price Index. The price for producers actually went down, and maybe that dragged down eventually the CPI as well. We saw lower inflation rates into the 1990s following those 70s and 80s. And then, of course, the red line, that spike higher in energy prices in the late 70s and early 80s that we all know about. And then, of course, in late 1980s, specifically 85, 86, and then we know the crash in 1987 followed that, the stock market crash, we saw energy prices really dramatically fall. So maybe, we don't know if history will repeat as it has in the past, but we certainly can use this as a template to say, okay, well, maybe if PPI continues to move higher, maybe that will lead CPI and the other inflationary barometers higher. And then, of course, if we see prices for energy and food really start to dramatically move to the downside, maybe that'll drag the rest of the consumer price index and the other inflationary numbers lower as well. What we're going to do is we'll continue to watch these numbers over the course of every new inflationary number, and we'll be sure to update you with any significant changes. We hope this has been helpful. We look forward to seeing you back soon.